Good afternoon, everyone. Thank you for joining us for our fourth and final Fiscal Futures conversation. It is a pleasure to have you with us again, and we are really grateful for you spending this time with us. So as I've said, this is our final conversation, and today we are looking at the topic towards a fiscal policy that supports economic recovery while achieving sustainability. If you have listened to any of our Fiscal Futures series before, you will know that we encourage you as much as possible to use the Q&A feature. We may not address these directly, but they will definitely be incorporated into our conversation as we go through it. So pulling together from the discussions in the past few weeks, we have been guided by the goal of increasing national income and also increasing employment. Today, what we want to do is we want to look at what would the shape be for a fiscal policy that is credible, sustainable, as well as supportive of an economic recovery. To help us discuss this, we have a very prestigious and distinguished panel once again, all of which are new faces except for one, and our host, Matthew Simmons. So we are still expecting a panelist to join. I'm going to introduce everybody in the meantime, and I'm sure as soon as he can, he will be with us. So first up, I would like to introduce the director of ERSA himself, Professor Johannes Fedderke. Welcome. He's also an economist and professor at the School of International Affairs at Penn State University and the Wits Business School. Also, who is not yet with us, Professor Ricardo Hausmann, who is the Director of Growth Lab at Harvard Center for International Development, as well as the Rafik Hariri Professor of the Practice of International Political Economy at Harvard Kennedy School. Also with us, Laurence Harris. Welcome, Professor. Laurence is an economic professor at the School of Finance and Management at SOAS University of London. He has worked with the Reserve Bank and National Treasury. Then also we have Abebe Selassie. Welcome. The director of the African Department of the IMF. With more than 20 years of experience at the IMF, I'm sure you know you are definitely in good stead to give us some good tips. Before that, Abebe worked at the government of Ethiopia and studied at the London School of Economics. Welcome. Then our familiar face from last week, Federico Sturzenegger. Welcome, as I said last week, currently teaching at the University of San Andrés and honoris causa professor at HEC Paris. Welcome. So combined in this panel, we have a wealth of experience from all countries, South American and from America, and definitely looking forward to some good creative solutions to our fiscal policy. So without further ado, I'm going to hand over to our host, Matthew Simmons, who will take over from here. Thank you, Matthew.
Thank you very much, Margot. Yeah, good afternoon to all of you. I'm Matthew Simmons, and it's my privilege to be facilitating this, the fourth and final episode of the Fiscal Futures series with ERSA. The fourth session follows on the success of the sessions on fiscal sustainability, financing the budget deficit, and fiscal policy and its relationship with growth. Videos of all those sessions are available online at the ERSA YouTube page if you have 2 hours of your day to kill and nothing better to do. The fourth session was always an opportunity to reflect on the discussions of the first three sessions, and as such doesn't have its own dedicated theme. We have put together a panel of experts with considerable experience and expertise in macroeconomic policy around the world. And the intention in doing so is to provide a kind of reflection on the domestic debate on fiscal and macroeconomic policy in South Africa. I hope that you, the audience, will find the approach and resulting discussions both interesting and useful. Unfortunately, Enoch Godongwana has not been able to join us today on the panel due to last-minute and urgent work commitments with the ANC. Also, members of this panel have pressing day jobs, and so we're going to have to manage our time very carefully and accordingly. Ricardo Hausmann will need to head off and teach after about an hour, but because the experience of Latin America has proved so useful in previous conversations, Federico has kindly agreed to come in at the last minute and to assist in taking the conversations forward during the second half. The format today is similarly unstructured to the previous episodes. We will start with a brief overview presentation to set the scene, and from there, we'll move into discussions. As usual, it'll be unstructured, and I will be relying on the participants' passion for economics and development to sustain the conversation. I look forward to seeing the reactions from the audience, so please feel free to use the Q&A function in Zoom to make any comments, contributions, or ask questions. So I'm going to start out. This is now my opportunity to give a presentation. And so I'm going to start out by giving what I hope is a reasonable and sufficient summary of the conversations we've had so far and some of the interesting and challenging questions that have resulted out of it. The intention is certainly not to be complete, and I will move very quickly through the debate and discussions. Did the screen just stop sharing? Let me try and do that again. Excuse me a second, looks like my PowerPoint suddenly closed. So the intention is not to be complete or exhaustive. I'm not a panelist. My intention is really just to stimulate the discussion and debate. And I think that we are now. Okay, I have it back. All right. Also, I see that Ricardo has joined us. Thank you very much, Ricardo. It's great to have you with us. I'm looking forward to hearing what you have to contribute. The first issue that I will come to is really just to cover the discussions that we had about sustainability. And pointedly, I've made the comment that the objective is to try and understand financial sustainability in a developing country with an unsustainable economic, perhaps even social structure. Having worked as a chief director of fiscal policy and then a head of the budget office, I guess that where you stand on an issue depends on where you sit. And I've always been of the view that fiscal sustainability is a necessary precondition to broader economic sustainability. It doesn't seem of much point to have progressive economic and social programs that one is unable to sustain into the future. But there is an interesting and important tension that we reflected on quite a bit in the first session between achieving fiscal sustainability at the cost or in the absence of broader economic development. So using the for the scenarios provided by the National Treasury, I've just made the point that the passive scenario is clearly unsustainable. And what I mean by that is it results in a continuous increase in debt to GDP, which has its own profound and negative economic consequences, but from a public finance point of view also results in continuously rising debt service costs, thereby crowding out more and more productive spending. The passive scenario is clearly unsustainable, while the active scenario is fiscally sustainable, at least in its appearance, as it does have a stabilization of debt to GDP, followed by this quite neat little tail off over time. But it raises the question of what are the economic and service delivery consequences of those two scenarios, and of course, pretty much everything in between. So does fiscal sustainability exist independently of broader economic sustainability? We spent some time in the sustainability session discussing what the IMF calls the automatic debt dynamics, which is the relationship between the interest rate and growth. Xavier de Bruyn provided us with this kind of illustrative mechanical example of how it works. Basically, he's given two scenarios where he very simply shows that with growth of 3% and an interest rate of 5%, you need to generate quite significantly large primary surpluses in order to offset the difference between the two. The green area reflects a falling debt to GDP ratio, the yellow area, a rising debt to GDP ratio. And with interest rates higher than the growth rate, the opportunities for reducing your debt rate are significantly smaller, and you end up in a situation where you have to run much higher primary balances in order to stabilize or reduce your debt to GDP ratio. As a counterexample of that, he's shown the opposite, where growth is 3% and your interest rate is 3%. As you can see there, that you are able to run, in fact, small primary deficits and still have a stable debt to GDP ratio or a falling debt to GDP ratio. Why this is important? Well, using the data from the IMF's DSA that they published a little earlier this year, you can see the nominal GDP growth and the effective interest rate. And you can see that in the recent past, this wasn't even a period of significant economic growth or success for South Africa. Nominal GDP has been in excess of the effective interest rate, putting us in this much more desirable scenario over here, where you are able to run small primary deficits in order to stabilize your debt to GDP. That has swung very aggressively in the recent past. It's not a function of COVID, it's been made worse by COVID. But already 2018, you can see that the nominal GDP growth rate is significantly lower than the interest rate, meaning that we have shifted to this scenario here, which requires primary surpluses, sometimes quite large primary surpluses, in order to stabilize debt. The forecast is not great either. Nominal GDP remains smaller than the effective interest rate for the entire forecast period that the IMF is looking at. Now, my impulse is always to talk about the importance of increasing growth, assuming that interest rates are a reasonable outcome of a robust price-finding mechanism. But certainly, the question does need to be asked, are interest rates too high in South Africa? There are a couple of useful market failure type of reasons why that might be the case. Firstly, the issuance of debt might be suboptimal, relying too much on domestic debt or short-term debt. Again, as a fiscal economist at the IMF, I worked on the Egypt program, and I saw very much the benefit of South Africa's long-term debt structure relative to Egypt's very short-term debt structure there. But under certain circumstances, it might make sense to focus more on the short end of the yield curve. But also there, are very important risk reasons as to why the interest rate in South Africa is and should be higher than comparator countries. We moved on to financing the deficit, and this is really where I think the point started to come home. South Africa has had a significant financing requirement for the last few years. It's been large. Market commentators have identified it as large. It's been part of a series of factors that have led to a downgrade in the risk ratings of the country. But you can see how relative to our gross savings, that financing requirement has increased, and increased substantially in 1920. What is alarming to me is I was anticipating seeing a very large increase in the financing requirement. But I certainly wasn't anticipating seeing a projected financing requirement that was in excess of gross savings for 2021. Now, that, one could say is alarming, is a shock, but it's just a shock. It's a result of COVID-related crisis, and those factors will unwind over time. Certainly, one can expect they will. But if I look again at the IMF's DSA, which I think is very much based on the Treasury's active scenario, so already a very optimistic version of how the public finances will evolve, one can see the gross financing needs of the country increasing from a period where the gross financing need was already high at 10.1% of GDP up to 20%. And the persistence of that, as it remains at around 20% until 2023, and then starts to tail off. But even by 2025 remains very large by historical measures, and certainly relative to our stock of savings at around 16% of GDP. We've always relied on foreign investment to close the financing gap, and that's been a stable and successful part of the public finances and financing the public finances in South Africa, especially since so much of that investment goes into the rand-denominated market. But what we do see is quite an important and significant tailing off of the non-resident domestic government bond holdings during the course of this year. Adding to that story, not only do we need to rely on foreign investment, but we need even more than we've relied on in the past. And investors have been declining as a share of the domestic market. And can we really rely on quantitative easing in advanced economies to continue to save us, and for how long? I have a kind of picture in my mind on this issue of a cartoon animal that has run off the edge of some cliff and is being sustained by a significant updraft of quantitative easing. But at some point, that updraft comes to an end or is no longer sufficient to contain the fiction that that animal is running on firm ground. We've discussed, and certainly within the South African context, the issue of prescribed assets is something that is discussed as a source of financing. And I think that the issue is complex. A number of people have talked very deeply and importantly about it from different perspectives. But from the perspective of our conversations, and to me, I think the real issue is that, sure, there is a lot of money under management in the South African financial sector, and that is a huge asset. But to what extent it represents an opportunity, I'm not sure. That money is not stored under a mattress looking to be reallocated somewhere. And given that so much of it is allocated towards private equity as well as government bonds, it's very tough to make the case that shifting private sector investment into the public sector will generate higher economic returns through more efficient investment by the public sector. The issue of quantitative easing or expansion of the monetary base or the provision of money to the government by the central bank at lower interest rates is something that is being discussed within the kind of commentary debate, and it's something that we've picked up on in most of our sessions. The arguments for tend to focus on it as an imperative that is necessary in order to sustain development. And that is certainly an intention or an impulse that I'm very sympathetic towards. The other big argument for it seems to be that it has been successfully implemented in advanced countries. I put that in inverted commas because I'm not sure that we know how this ends, and so I'm not sure that we are able to say yet whether it's been successful or not. But be that as it may, it doesn't change the fact that in South Africa we still have positive policy rates, and is expansion of the monetary base a useful contribution to financing in that, or to economic stimulus in that kind of environment? For the 1 or 2 or maybe 3 developing countries that have done something that looks a little bit like expansion of the monetary base, they've done so with policy rates that are pretty close to zero. So certainly in a very different situation to where we find ourselves. We also still need foreign investment. And so that idea of a credible central bank that is able to responsibly manage over a significant period of time is a very valuable and important asset, and a very valuable and important part of how we finance the public finances. So while there may be some opportunity to introduce liquidity or money into the reserve base of the economy, monetary reserve base of the economy, there has to be a limit as to what can be done. It, of course, doesn't address the fundamental problem, which is that the stock of debt and interest costs are so high. And the idea that it addresses a demand problem in the economy, to me, is an argument that needs to be done needs to be made in coexistence with reform to the supply side of the economy. Given the assessment of the economy that I think has been very well made through these seminars, the supply problem cannot be ignored. And any demand response that you might want to implement has to be done in careful coordination with a supply reaction too. The same is probably true for the other way around. Any supply side response probably requires some kind of demand side attachment as well. And basically, is one saying that the economy should grow to fit the size of the budget? Is one saying that one is able to stimulate the economy to the point where the size of the budget makes sense, rather than the other way around, where the budget needs to be tailored to fit the economy? Moving on to economic growth, fiscal policy, and the budget, where the question is the role of government and fiscal policy in supporting an economy that can generate employment opportunities and finance its social and redistributive programs. Just to make the point that it's not a COVID issue. COVID has made a bad situation worse. Accepting that the economy will recover is just simply not good enough. What does the economy recover to? We need to remember that it was growing at 0% before COVID struck. If one has a look at the debt to GDP ratio ending at the pre-COVID point, the end of 2018, one does see a very significant and very rapid accumulation of debt. And again, where you stand on an issue depends on where you sit, and given my experience, this is something that looks terribly alarming and serious to me. I'm somewhat surprised by the extent to which the commentary of fiscal policy and economic policy accepts this. And the issue is not necessarily, was it correct to increase debt, and was it correct to increase debt very aggressively? Certainly, this was a period of some economic stress for the country. But what did we get in exchange for accepting that debt? Combined with large deficits and an increase in debt, growth has been lower and in fact has declined recently. Interest costs are now the fastest growing item of spending in the budget and are now a very significant part of the budget. I'm not sure we've actually generated any assets. I'm not sure what we've managed to build since the Gauteng Freeway Improvement Program. There's been a declining productivity of the public sector. And while, I've seen quite a bit of analysis that shows that the coverage of public goods has continued to grow in that period, the quality of those goods has not always improved, and certainly in certain important metrics has declined. So if we want and need a big government, how do we get more from it? And in fact, I think it raises a very important, more existential type of question, which is simply, how big should government be? We tend to have this assumption that our social and economic deficits are so urgent and so profound that there is no limit to the size of government's response to it. I can accept that on a kind of moral level, but from an economic point of view, and in terms of how these things work out in the macroeconomic environment, there has to be some kind of prioritization. There has to be some kind of engagement with urgency that, in a way, forces us to question how big a government we are prepared to to accept, and how we are going to go about financing it. On the economic side, very simply, we've stopped investing in the economy. It's obviously much more complicated than that, but at its heart, that remains, I think, an important and structural feature of what has happened to the economy over the last 10 years. These graphs from Chris Lowalt show that dynamic very effectively. You can see how gross fixed capital formation, which was never sufficiently big or never as big as we wanted it to be, has declined and declined quite precipitously in the recent past. While at the same time, total consumption has continued to grow and grow quite robustly. The role of government in that dynamic needs to be accepted. Basing everything at 100, you can see how it's growth in compensation and interest that has driven the growth in total expenditure by government. Investment, in fact, has declined and declined quite strongly. What makes this more urgent is the pressing consolidation needs that government has, and the fact that the consumption-linked expenditures are much harder to cut than the investment spending. And we've certainly seen how over the last few years, and the need to limit growth in government spending, the investment programs of government have been curtailed and cut. So it's not about austerity and it's not about stimulus. This bipolar debate that we have, where something is either austere or it's either stimulatory, is not terribly helpful. What is required is a platform of economic reforms aimed at reducing the cost of living, the cost of doing business, and the cost of finding work. A couple of headline issues that come to mind that would support that are proper electricity sector reform, reform in the regulation of network industries, and addressing the drivers behind administered prices. But there are no doubt many other reforms that would be equally important. On this platform of economic reforms, the government needs to construct a credible commitment to significant expenditure constraint, an expenditure review program aimed at significantly reducing consumption expenditure, whilst introducing a program of well-planned investment focused mainly in urban infrastructure. Anybody who thinks that is utterly uninteresting is completely right. There is nothing new about that statement. In fact, the Treasury and government have been advocating versions of that story for over 10 years now. What is new is the unprecedented economic deterioration, the financing constraint and stock of debt, and the emergence of fiscal stress. Now, markets are noisy, but they're not crazy. And markets seem to be trying to tell us something. Mamakete Lejani provided us with some graphs, which I think are very useful in communicating this idea of emerging fiscal stress. This is the South African versus the emerging market bond yields. You can see that it's below the average. I was looking at another graph by the IIF on this a little earlier, and it showed something very similar, but for a much longer period of time. Something around July 2019 has triggered a change in the understanding of risk in South Africa, public finance risk in South Africa relative to other emerging markets. As another illustration of that, this gives the yields of these countries against the credit rating or risk rating that those countries are formally assigned. Now remember that South Africa has been downgraded, but at its formal risk rating at this point here, its bonds are actually trading at a higher yield, a yield that is more consistent with the country at this risk rating here. Again, markets trying to tell us that there is the emergence of significant risk and the possibility of fiscal stress. I don't mean to suggest that this is something government hasn't heard. I think that the supplementary budget, for whatever challenges and failures it might have, is a very important and honest acceptance of that risk and attempt to engage with that risk as a way forward. So I will wrap up that very incomplete presentation with just simply this question. How does government contribute to significantly growing employment and resources for social spending and redistribution? And why don't we do it? There are any number of growth plans for South Africa generated over the last 15 or 20 years. All of them have useful elements and components and similarities and overlaps. Yet the progress made in delivering any of those reforms remains frustratingly, tragically, hopelessly slow. So on that note, let me hand over to, I think let's start with Ricardo for any reflections that you might have on the situation in South Africa, in particular those that you might have coming out of that presentation. You're on mute, Ricardo.
I guess now I'm okay.
Perfect, thank you.
All right, well, let me say that thanks for this invitation. I'm so happy to be thinking about and discussing these issues in South Africa. It's a country that's super dear to my heart. I understand that we're having this discussion in the context of a fairly polarized political discussion within the country. So I really commend you for trying to find common ground in this discussion. I've always looked at South Africa with an unhealthy degree of envy, because, as you know, I come from Venezuela, and I know how things can be messed up, but in particular, this incredible capacity we're having right now of having a civilized discussion on the policy predicaments that the country is facing, that's really something that is, we stopped seeing in Venezuela a long time ago, and it's an incredible asset, because if societies don't have a space in which they can discuss their problems where it's about the arguments, not about the people. It's a debate of ideas, not a fight of the integrity of individuals speaking and so on. So this is fantastic, and I watched the previous meetings, and I thought that they were really first class. As many things in South Africa are first class. I mean, it's easy to forget that you have, a first class financial system, that you have a first class, reserve bank that has, credibility and monetary autonomy and so on. I mean, over the course of my life, I've worked on, something on the order of 50 countries, and I really, of all the 50 countries, this is the one that has, a really precious macroeconomic setup in terms of being able to have incredible financial depth, incredibly credible monetary policy with low inflations, that you're able to respond to crisis by lowering interest rates and doing some quantitative easing, and so that monetary expansions and an active monetary policy. I mean, these are things are not easy to achieve. Very few countries are able to do it. You've been able to do it. Now, obviously, South Africa is an outlier in the world in terms of the very low rates of employment as a share of the working age population, and that's not because people are not trying to work. It has, one of the highest, if not the highest, rate of unemployment in the world, and obviously, to achieve the social goals of the country, you would want a much bigger economy that could include many more of its citizens, and that's obviously, one of the goals that has been there since 1994, and it's still to be achieved. Obviously, a much bigger economy, a much bigger GDP, would make fiscal solvency issues more easy to be dealt with. Obviously, in these equations that Chris Simmons was showing of R minus G and so on, a bigger G would make things easier to begin with, but would also achieve other social goals. Now, in addition, we have COVID, and one way to think about COVID is that it increases the marginal utility of current spending, right? Because you want personal protective equipment, you want the ventilators, you want the testing, you want the public health interventions, you want to help people be able to support the lockdowns and the social distancing measures. You want firms to survive until we get this behind us, etc. So all of this increases the current demand for public funds. So in here, South Africa is not alone in having a situation where through lockdowns and other shocks, you get a collapse in tax revenues, you get an increase in the need for fiscal spending, so you get these humongous fiscal deficits. Now, countries differ in whether they can afford them or not, it's very clear in some countries, say like Ecuador, where there's no one willing to lend to the country. The country has to go to the IMF and maybe the World Bank and so on, and try to put together a group of public international institutions to help them through, right? Other countries like the US obviously don't seem to have a problem. They $1 trillion here, $1 trillion there, $1 trillion is 5% of the US GDP. They are up to $3 trillion now. That's 15% of the US GDP. And that's just in authorized spending, not counting, the probable significant declines in tax revenue. So they're going to run a humongous deficit, and the 10-year bond is at 0.6%. There is clearly a situation where you might say there's no obvious problem with running large fiscal deficits. Well, in between you have South Africa, right? That it's a country that was downgraded before this happened. So there was already a concern of the solvency of the country before the crisis. And with the crisis, we have seen several worrying things, right? The first one is the departure of foreign investors. Now, that was a common phenomenon in March and April. All the countries, and through the Growth Lab, which I created in 2006, in part thanks to our work in South Africa at Harvard. We've been working with some 12 countries on how they managed the COVID shock, and they also, they suffered from this stampede out of emerging markets in March and April. But since June, there's been a massive return of international finance towards emerging markets. Several of the countries that we work on have been able to, countries that have a much worse credit rating than South Africa, they were able to go back to markets and fund themselves and so on. But I was really impacted by the graph showing the decline, persistent decline in foreign participation in the debt markets in South Africa. And the increase in the participation of the domestic financial system. That is a yellow light in any book. And finally, I mean, you see a steepening of the yield curve. The short end has come down with monetary easing, but we didn't see sort of like a decline across the whole line. We saw a tilting of the curve. So at the long end, at the longer maturities, you have higher interest rates than you had before. And this is also a worrisome sign. So South Africa is a country that cannot be as blasé as the United States about whether the projected fiscal deficits will be financeable, or whether you may get an accident And you might think that accidents are things that happen to other people, but you know, Federico Sturzenegger lived through an accident in 2018, and he's in the panel. And I've lived through a ton of those in Venezuela. And you know, for 7 years, I was the chief economist of the Inter-American Development Bank, and I saw it in a bunch of countries there. So these things do happen. It's not that they never happen, and it's something that I'm sure that any responsible South African cannot dismiss, and cannot dismiss on purely theoretical or ideological grounds. It's things that can happen, might happen, did happen in the US in 1929, and it did happen in the US in 2008. And so it's not that these things never happen, they do happen. Now, that doesn't change the fact that you know, the marginal utility of public resources now is very, very high because of the pandemic. And so you really want to be able to borrow as much as you kind of can to support the recovery and to support the management of the problem and the recovery. And so how do you square the circle? And economists have found out one way to do it, and the idea is that if you're able to anchor medium-term expectations, because you have some commitment device that shows that you're improving the medium term, then markets support you in the short term, right? So you increase your availability, you increase your fiscal space today if you're able to commit to something tomorrow. And you know, we saw this recently in I guess it was 2018 or 17 in Brazil, where you know, the whole fiscal dynamics was going in a horrible direction under Dilma Rousseff, and in came Temer, very weak president with a very weak and tenuous mandate, and they announced a program that involved a pension reform that improved the medium-term fiscal situation, and as a consequence, they got massive current financing that allowed them to dramatically see lower interest rates and dramatically improve debt dynamics. So sometimes you can do things that if they anchor medium-term expectations, they improve the short term. So you get so you get out of the bad debt dynamics through and increase degrees of freedom in the short run. So I'm going to ask myself questions. You know, if something like, you know, what could be done in this direction in South Africa so that you maximize the current availability of funds, and that might be, I mean, the miner's canary would be that you do something, right, where suddenly you start seeing these foreign inflows coming back and have you know, a bond issuance oversubscribed significantly with lower rates and a less steep yield curve. So we would know if things are improving, we would, you know, they would give us financial signals. Now, there are some growth puzzles in South Africa, because as Chris was saying before, you know, before COVID, you had zero growth. You had actually a recession before COVID. So something is keeping growth low. And you know, if you come as me, say, as a Martian into South Africa, you know, things that really find surprising is amazingly low internet penetration. Amazingly low internet penetration, not by US or European standards, but by lousy Latin American standards. So very low and super expensive internet penetration. how would you explain that? Is it that your financial system is too lousy? Is it that your corporate system is too lousy? I don't think that can be the answer. You're pretty much the only country that didn't see a significant expansion in output during the commodity super cycle, during a significant increase in mining output during the commodity super cycle. In many of the countries that I've worked on, and many countries, mining countries in my part of the world, high commodity prices led to an investment boom and a big expansion. And now, why did that not happen in South Africa? Is it because you don't have the resource base? I don't think so. Is it because you don't have the technology? Quite the contrary. You have mining companies that are multinationals and that have found plenty of other places to invest in. Is it because you don't have the ability to mobilize the finance, which is something that happens in some places? Well, definitely not. You are the country with the most advanced financial system of the developing world. So really the puzzle is, how did it not happen in the place that had it all? And so another growth puzzle is, you can, some countries sometimes mess up electricity planning, right? And because they grew faster than expected, and electrical capacity takes a long time to set up, etc. And maybe they have a period of load shedding and electricity shortages. But it's been like 12 years or so since load shedding started to be a problem, and why the hell? So why is it still there? Why haven't you seen, if there's excess demand for electricity, why haven't you seen a boom in investment and an increase in supplies and so on, just as the normal result of having shortages, right? The market generates the incentives to allocate more capital there. So these things need an explanation, and these if we want to think of policies in say in a three-dimensional space, some policies may be good or bad for growth. So think that whether good or bad for growth as in one space, one dimension of the space. A second dimension of the space, say, is they are good or bad for inclusion, to get more citizens involved in more productive activities. So are they good or bad for inclusion? And are they good or bad for fiscal solvency? So let's think of that three-dimensional space. Are they good for growth? Are they good for inclusion? Are they good for fiscal? Well, obviously, these network industries are, check, right? Win, win, win. They, can't, you're asking companies to reduce their output so as to save electricity. So you're having a direct cost in terms of output. You are excluding people from the possibilities of progress through lack of supply. In the context of COVID, not having internet, internet is what have saved all of us in the context of COVID. That's why we can have this discussion here. And obviously, these things would be good for the fisc. Why is there no more bandwidth? If that generate more supply and more money for the government and so on. So I think that this is not only an opportunity, but it's a reflection of something that is deep and important, and that we need to get our minds around. Whether typical answers, well, there's some rent seeking involved. There might be state capture was part of the problem, but maybe part of that state capture has been unwound. Maybe it's a conflict with the incumbents who don't want to see new entrants and alternative sources of supply and competition. But maybe it's just a lack of state capacity. that you have a state with very highly differential capacity that has world-class regulation of finance and non-world-class regulation of other sectors in the economy. It may be because of interests, but it may just be because of a lack of capacity. So that to me is a puzzle. I would like others to help me out think through those issues, because as Chris has said, this has been part of the policy proposals in South Africa for forever, but it doesn't seem to happen.
Thank you very much.
Let me just the last thing, and I would like to know how to achieve this medium-term fiscal commitment so that you can maximize short-term fiscal space. The trick in Latin America was through pension reform, because pension reform lowered the net present value of future pensions, and you get today's solvency. But you are fortunate enough to have a good pension system that is not a source of fiscal problems. So I want to know what ideas there are that can commit to that medium-term fiscal solvency that would express itself in an increased fiscal space in the present. Thank you very much.
Thank you, Ricardo. I mean, I think there's a lot there that we can reflect on over the remaining time. I know you need to go and do some teaching, so please feel free to drop out when you need to. But a couple of things that really resonated with me. The first is this idea of anchoring medium-term expectations, something that the government used to have as an asset. The ability to say we are needing to push the fiscal throttle in the short term, but you can believe in our credible commitment to correcting that or stabilizing that in the medium term. And persistent budget cycles of under-delivery on that medium-term commitment, the pushing out over 10 years of that point at which debt will stabilize, seems to have led to a significant erosion in the government's ability to motivate and market the credibility of that story. But the other thing I really liked about what you were saying was introducing the idea of kind of binding objective constraints to growth. It's been 13 years of load shedding. But it's not the only area of economic regulation where, it would be excessively kind to call it suboptimal. Let's just say that government is failing. And why? Why, with the effective diagnostic that we have, the quite clear plans about what it will take to address this, so little is being done? I mean, the government says, and the government needs an investment program, an investment boom. The private sector is capacitated, resourced, and excited about investing in private generation of electricity. Why are they not unleashed to deliver on that? And then thirdly, linked to that, the kind of political economy of why decisions are not made. I told the story in the last episode about a Chilean consultant I had who would say to me, the goalposts are so wide. All you do is you discuss kicking the ball, but nobody ever kicks it. If you were to just kick the ball, you would probably score a goal. Just do something. Stop discussing the perfect goal and just kick the ball. On that, let me hand over to Johannes to reflect on what we have discussed so far.
All right. Thank you very much, Matthew, for the invitation and to participate in this debate. I've listened to the discussions over the last 3 weeks, or the last 3 sessions, I should say, with a great deal of interest, and your framing of the problem with Ricardo's additional observations with a great deal of interest. And one thing that I'd like to note right at the outset is that a strong positive that I'm taking away from the discussion thus far is that in contrast to a lot of the policy debate in South Africa in previous time periods, there does seem to be, and very reassuringly, the emergence of a consensus on just how important and central economic growth is going to have to be to economic policymaking in South Africa. And as I say, whereas there was a lot of rhetoric around discussing economic growth previously, as you've just been made aware of, not necessarily all that much action. So that was a big positive that I've taken away from the debate thus far. But it has also left me with a certain degree of concern in terms of just how the discussion often frames the thinking around growth policy. And to give an analogy, it's almost as if the discussion has as a starting point that South Africa is like Canada, that South Africa is effectively operating somewhere on the international production possibility frontier, and not only on the international production possibility frontier, but on the international technology possibility frontier. So that all that, when you're talking about growth, you really have to think about are relatively small and relatively short-term fiscal and monetary policy and demand-side stimuli in order to move in order to move the economy back onto a full employment equilibrium. And as the discussion has already made clear, that's really just not where South Africa is. And in fact, the relatively small interventions and these relatively short-term interventions that keep on being discussed on the demand side policy interventions are really anything but relatively small, nor are they relatively short term. But there's a deeper problem really, and that is that the growth conundrum that South Africa faces is not just a short-term shock phenomenon. It's really a much more fundamental constraint on the economy. And so the first point that I'd like to make about the conundrum that South Africa faces surrounding growth there is that this is not a short-term phenomenon. It's a very long-term, deep structural issue. And as a consequence, it's inherently a supply-side issue in the ability of the South African economy to generate growth. Now, there are umpteen analyses that have made this point. The IMF has numerous contributions on this. I've certainly been involved in a number of analyses that have highlighted this long-term structural decline in the growth capacity of the South African economy. And if you're really honest about it, that decline started at the end of the 1960s, but has certainly been very evident, at least since the 1980s. And since the 20-teens now, the growth capacity of the South African economy doesn't even match population growth any longer, and now lies considerably below population growth. So we're now in a situation where, in fact, there's a per capita welfare lowering year on year, rather than a welfare improvement. And just to reiterate a point that Ricardo made and that you, Matthew, made, this is not a COVID problem. This long predates COVID. And it is not temporary. It's a long-term structural feature of the economy. And the only thing that kind of hid this for a short period of time was the commodities boom of the 2000s that's distracted from this trend. And just to point out how unique this is, if you compare South Africa with other emerging markets, from the 1960s to the 20-teens, the mid-20-teens, South Africa was able to increase real per capita GDP by something like 43%. By contrast, in Argentina, that figure is about 75%. In the Philippines, it's 108%. In Egypt, it's 268%. And in a country like Malaysia, it's something like 500%. And we're not even talking about the Asian tigers, such as Taiwan, Singapore, or South Korea, or China. So South Africa really is an outlier amongst emerging markets in its incapacity to get onto a real sustained growth path. The second point I'd like to make about the structural growth capacity of the economy to growth is its exceptionally poor labor absorption. Ricardo has already pointed to the very high unemployment rates that we have in South Africa. But it is also now the case that less than 10% of the population is in formal private sector employment. And this is not just a function of the youth bulge in the population. It's directly and explicitly an expression of the fact that the labor market is not able to generate jobs for the economy, and that people who want jobs and desperately need jobs are not able to find these. And you can show through econometric analyses that this failure of the economy to absorb labor and to create jobs is, by the way, also a direct and immediate and very strong contributor to the levels of inequality that we observe. So this is more than just a question of rands and cents. It's also a question of horizontal equity across the population that immediately gets affected by this poor capacity to absorb labor. A third point, and one that hasn't often been discussed in South Africa, is that South Africa's growth path is also not a balanced growth path, but it is in fact an unbalanced growth path. And what I mean by that is that the growth of the South African economy has not been equally and evenly spread across all of South Africa's economic sectors. There's a very significant sector bias in economic growth. And the really disconcerting feature about this unbalanced growth in the South African economy is that the strongest growth has occurred in sectors that are actually the lowest in generating productivity growth, in total factor productivity growth. So what you've got is not only a low and declining growth capacity in the economy, but what growth there is shifting from sectors that are generating high productivity growth to sectors that have low productivity growth. And that is where the employment is shifting. Now, the explanations of this really lie in the nature of the price elasticity of demand and the existence of pricing power in the output markets of the South African economy, and I'm not going to dwell on that. But what it does emphasize is that the nature of the growth and the distribution of the growth in and of itself, what growth there is, the nature of the distribution of the growth is in and of itself a problem in terms of the ability of the economy to improve productivity. So in terms of the diagnostics, just to summarize, what we're seeing is a low and declining capacity to grow, a low and declining capacity to employ, and growth, if you wish, is in the wrong place, in low productivity sectors rather than in high productivity sectors. And as a consequence, the bottom line is that the reason South Africa is unable to grow is not a demand side problem. It is a deep structural supply side problem. So what do we do about it? And I mean, this is something that we could talk about for a long time. I'm just going to summarize a couple of areas where I believe there are where the major structural constraints to the South African economy are. And I think what is frustrating for those of us who work on determinants of South African growth and the impact of growth in South Africa is that South Africa has so much going for it. It really could be an African lion in terms of growth performance, and yet it persistently disappoints in its ability, in its realization of its fundamental potential. So where are the major bottlenecks? The first thing is factor markets in the economy just have to work much, much better than they are at the moment. And fundamentally, economic policy has to start taking seriously the factor markets that South Africa actually has, rather than those it wishes it had. And this works across both of the principal labor markets. The first I'm going to talk about is the labor market, the incredibly high unemployment rate. It is simply unrealistic to anticipate that poorly skilled, poorly educated workers with little or no on-the-job experience, and that they simply don't have access to labor market insider networks, are going to be employable in high value added skilled jobs. They won't be. So the labor market policy needs to take seriously the need to get a wide sector of the population, which is characterized by low skills, by poor education, with little prior job experience, into the job market at wages that are actually feasible for those levels of skills. So labor markets need to realize far greater flexibility than they have at the moment. And just to emphasize, this is not an all or nothing thing. It's not that you're either going to go for a Vietnamese a sweatshop or the labor market of Sweden. There are many in-between solutions. And in fact, we had a discussion under the ERSA and South African Reserve Bank umbrella just a week or so ago by Filippo Taddei, who detailed the Italian experiences of reforming a labor market in order to improve the employment prospects of people, of workers in the economy, without relinquishing relinquishing serious protections for workers in the labor market. The investment side has also already been talked about. Investment rates in South Africa are low. They are moving in the wrong direction. And I think there are a number of issues that actually are relevant here. One is policy uncertainty. Since the 2000s, the South African economic policy realm has moved into a situation where the degree of policy uncertainty is much higher than it was before. And we know what the effect of that on investment is. There's been lots of work done on South African investment. There's also lots of international evidence that makes it very clear that uncertainty is a death knell for investment rates. But in the South African case, you've got an additional problem. And the additional problem is that if you take a look at interest rates in South Africa, whereas the absolute level of interest rates is not particularly high by historical standards, if you take a look at the yield spread between South African long-term government debt and US government debt, that yield spread is back to the levels that we last saw in the 1980s, at the period of maximum risk exposure in the South African economy. And the immediate implication is by international standards, the cost of borrowing in South Africa is actually exceptionally high and seems to be reflecting deep underlying risk. And by the way, once you start decomposing what is driving that yield spread in terms of macroeconomic fundamentals, what you find is that there's a number of things that matter. Growth matters, inflation matters, exchange rate risk matters. But actually, the single factor which drives the whole story, the single factor which accounts for virtually all of the rising yield spread, has been the rising the debt to GDP ratio of public debt. So the increasing borrowing requirement of the South African government in order to finance its budget deficits that you pointed out, Matthew, is something that has led directly to the driving up of that yield spread, and therefore for an increased cost of borrowing. Output markets. It's not only factor markets that are too rigid. Output markets are too rigid too. There's extensive evidence now for South Africa that points to the existence of significant pricing power in South African output markets, and that there are significant costs to this. Lower productivity growth, lower investment rates, lower employment growth. So it is vital that not only the flexibility of factor markets get addressed as a matter of urgency, but flexibility and particularly ease of entry into output markets is equally important. So some interventions that are low-hanging fruits, easing market entry for both domestic and foreign participants, shifting in the focus of industrial policy from trying to pick winners to instead trying to remove barriers to anybody and everybody that wants to participate. And there are other sorts of interventions. Improving the quality of education is an immediate one. Infrastructure, it's not just the constraint of ICT infrastructure that Ricardo mentioned. The fact that we've taken 15 years to address the significant constraints on the South African economy from the ability to generate power that has already been mentioned. It was predicted before the blackout started, and yet 15 years later, we are still sitting with this problem. So when it comes to fiscal policy, my fear is that there are certainly times when stimulus is necessary and appropriate, such as in 2008 and with the impact of COVID. But unfortunately, the fiscal space that was created by the late 1990s and early 2000s has effectively been eroded. It's impossible to therefore argue that the fiscal stimulus, that the strong fiscal stimulus that has been in place since 2008 is a temporary phenomenon. It's been continuous and aggressive since 2008, and we haven't seen any growth response. So, and the consequence has been that the resultant rise in interest rates has effectively generated a crowd-out problem. Let me stop there, Matthew. There are some additional areas where you can think about growth-related policy interventions, but perhaps we can circle back to that later.
Thank you very much. I mean, a lot there to chew on. Thank you, Johannes. And I think, you know, for me, a very useful identification of both the structural reform imperatives, but also the role of stimulus in tandem with that, but the contradiction that we face where we have probably in effect burnt so much, maybe all of our stimulus potential, at least from the fiscal side, which leads to this debate about how do we get more out of the monetary side and the possibility of us leaning too hard or too heavy on something. But I think also, you know, just terribly important that while what we feel is the demand side of the economy, what we need is the supply side of the economy. And there is this weird dynamic in the South African debate where we shift towards quite stimulatory impulses and ignore the very difficult and very profound structural and budget-related sources behind our economic malaise. There is a question from the audience about fiscal multipliers, and it's something that comes up from time to time. And I mean, just anybody is welcome to comment on it. My personal view on economic fiscal multipliers is that I've chosen to ignore them because I don't find them terribly interesting or useful. They're a kind of outcome of the historical choices in the data. But what is much more interesting and much more powerful is how we contribute to a conversation with government about how they use money much better, how they have a much more productive budget or utilization of public funds. So to me, without doubt, fiscal multipliers have declined and declined significantly. It's no surprise to me if what you're spending your money on is capitalizing bankrupt state-owned enterprises. The multiplier can't be greater than 1, might easily be greater than 0, might easily be less than that. But the fact that it has been so low doesn't preclude the very important contributions, positive growth contributions that government could make. But taking kind of Johannes' comments about fiscal space, the structural reforms, the erosion of opportunity for stimulus, let me hand over to Abebe.
Matthew, thank you so much. Thank you for inviting me to this event and allowing me to weigh in. So I have to say it's a bit difficult coming after your fantastic presentation, Ricardo's comprehensive take, and Johannes' also deep insights. I don't know what else I can add, but forgive me if I'm repeating points that have already been made. They have many of them, but I'll try and add my own color. First point I want to make is that, you know, I'm always reminded of a very insightful comment that was made to me in my first visit, first day of work that I had in South Africa when I was appointed mission chief. I met with a very senior government official, and he said to me, you know, to really understand the economic policy debate in South Africa over the last 15 years. So this was 2009, so really going back to 1994. said, a person said to me that really has been a debate between two camps. There's one camp which sees a stable macroeconomic environment, conservative, sound macro policies as the bedrock on which growth can be facilitated. And so the macro policy settings have to remain neutral to conservative. There's another camp, the person explained to me, which sees that, this kind of sound macro policies that that is idealized by institutions like the IMF, by some of the macro wing in the debate in South Africa, is really more applicable to countries like Denmark or New Zealand, small advanced economies where inflation targeting could be expected to work well, etc. And South Africa is not like that. South Africa is an economy where you have a mix of, very frontier market, emerging market type economy with an advanced economy. And the kind of policies you need there are, not so much neutral macro policies, but macro policies that are more supportive of strong economic development, stronger transfers to facilitate more of an income convergence. That was an interesting take and, insightful point. And, that's something that I come back to again and again and again.
Abebe, I think you've become muted.
You muted yourself.
I beg your pardon. So the 2010s, I was saying, were a period where by design or playing defense, macro policy was as supportive as it can possibly be, as very nicely shown by that chart on how the debt to GDP ratio has gone up. And I think, fiscal policy has been fairly supportive also. But I think, again, this is really almost like a monocausal explanation for the fiscal outcomes that we're seeing. And, I think there are deeper explanations for the big increase in debt that we saw in this period, which, of course, has to do with, as Ricardo put it, the growth puzzle. So it's not just about fiscal policy having been supportive and loose, but also about the growth failure. Now, the 2010s were not a particularly good period for EMs by and large, but even by at least non-Asian EMs, but even by non-Asian EM standards, South Africa has done really, really, of course, very poorly. And so we have to think about what is behind the weak growth outcomes that we've seen, despite fairly supportive macroeconomic policies. So, so my first point really is that this debate at some level has been there for a while. It's a debate that probably started around 94, 95 and has not been resolved just yet. But of course, macro policy space is running, is reaching its limits. So we have to be thinking a little bit more about growth and what's holding back growth to understand and find a way forward. In this regard, I think, as others have said also, what is really striking and abysmal is that investment, private investment in particular, has been, not only weak, but declining. A year or two ago, some colleagues of mine did some work where they showed that if growth in the last pre-COVID 3-4 years had stayed at the 2011 level, at 2011, which itself was, of course, markedly lower than the levels it was at in the 2000s, growth would be of the order of 3.5%, rather than the close to 1% that we were seeing. So, in a big part, at least in terms of identities, it's the decline in private investment that goes a long way towards explaining why growth was so weak, was so anemic for the last 5-6 years in the run-up to COVID. As to why that is, of course, political uncertainty, policy, economic uncertainty has a big chunk to play. But I have to say, our work suggests also as much that there are deep issues in the product market structure in South Africa. Product market competitiveness is not as helpful as it could be. So I think there are issues there. I'm reminded of this really by the point that Ricardo made about how limited internet penetration is in South Africa. In a country where you have deep and liquid capital markets that private sector can tap into. Why is it that internet penetration is so low? Why is it that the price of data is so high relative to other countries? And I have to say here, I have it's anecdotal, but really a pointer that this is not a new issue, but one that goes way back. I remember in 2009 when I was started traveling to South Africa. The resident representative that we had for the IMF at the time had just got a BlackBerry phone, and the price he was paying for data services was one of the highest relative to other countries in Africa, who didn't even have direct cable lines, but rather were relying on satellite TV. And the provider that the fund was using at the time was MTN. So that was a small kind of data point which showed also, again, some issues with the same company that's providing services in South Africa versus others, pricing much higher, notwithstanding the better infrastructure in South Africa. Now, of course, they could be pricing to market, etc. But I think, again, this speaks to the product market environment in important sectors like network industries not being quite as good as it could be. So I think the growth puzzle, I completely agree, going forward without understanding the reasons behind private investment being so low, the need, what needs to be done to facilitate private investment. I'm not sure that we will address the fiscal challenge the country faces. Now, I do want to say a few words about 2020, COVID, and I think, the chart that Matthew showed earlier about, potentially the gross financing need being higher than gross national savings, etc. I mean, this is a really difficult and special year, and every macro aggregate that we're going to look at is going to be so distorted this year. So I'm not sure kind of how much we should be drawing big conclusions in a year where you have such a big shift in all the macro aggregates. Second point I want to stress is that, I do think kind of this year is going to be one where there's going to be a big change in how we think about debt tolerance across countries. I'm not sure in which direction this is going to go into, because what we've seen, of course, in many advanced countries is a massive increase in public indebtedness, and despite that, very low levels of interest rates. I don't know if this is a temporary thing, we'll see, but I do think that both for the advanced market universe, but also EMs, frontier markets, low-income countries, we are going to be thinking differently about debt tolerance, and time will tell how this is going to be seen, but other things being equal, I do feel we are in for a period where sovereign indebtedness, sovereign balance sheets are going to remain encumbered across the universe of countries to a significant degree. So in and of itself, the big increase of debt in South Africa, while I do worry and needs to be, begin plateauing and coming down over time, of course, just again, the big jump, the big discrete jump that we're seeing this year, we have to take within a broader context. All the more so because household and corporate balance sheets are not as encumbered, at least relative to other country standards in South Africa, as so there is some strength relative to other countries. Perhaps circling back to the way forward and the point I said about growth, in terms of the simplistic framework about thinking about that sustainability, you've talked about R minus G, Matthew. So, we do have to drill down and try and understand what needs to be done to generate growth, and that itself is a big agenda and a big issue. But the other variable, of course, I assume is exogenous. The other variable that we have to think about, of course, is the primary balance. And here, I think the big chunk of spending in South Africa is quite good and quite, does a lot to address the income inequality that we see in the country. By the same token, I think one of the sources of pressure on the government balance sheet, on state finances, of course, has been the SOE sector. Where I do think that there is a lot of scope to try and make sure that there's a hardening of budget constraints, that there is better accounting and better resource utilization. So there is some space in the public debt dynamics on the state-owned entities' balance sheets where savings can be made to facilitate a better primary balance than the country has at the moment. So it's not that South Africa has run out of bullets by way of getting fiscal into a decent position. This last point that I'm going to make is a little bit more speculative, the country that I'm reminded most of when I think about the South African economy is India. First and foremost, of course, it's a boisterous democracy where policy making is not as easy as it is in other environments in many Asian countries where there is a lot more consensus, perhaps. Second, I think India, like South Africa, was a country that for many years had strong public institutions, law courts, of course, a democratic structure, even policy-making entities, but was under-delivering on growth. The Hindu rate of growth, as it was called for much of the 70s and 80s. But, India also found a way to engender very strong growth in the 1990s in an environment that still remained contested. And I do think that in South Africa, when in thinking about how to facilitate growth, we have to look at in countries like India, where sectors which can be sources of growth, which are new growth, need to be identified, rather than holistic reforms that we've been wishing for and hoping for in South Africa, in the labor market, in the product market. And that somehow they will be able to come about easily. I don't think they will. So I think one question I want to put on the table is really about how to identify those sectors, those parts of the economy where a lot of strong growth can be engendered, playing to the strengths that the economy has. This is a lot of hard work. It's not, to entail quite a lot of reforms, but I do think that, thinking out of the box a bit like that is going to be necessary. A key issue, and one where I think India did really well also, is, and something that South Africa could emulate with, this is to try and address a question that Matthew put on the table about what did all of this fiscal expansion buy? What are the outcomes? I think South Africa, in terms of public finance management, continues to have, at least at the input level, very strong systems, very strong institutions. Problem a little bit has been, I think, there hasn't been enough measuring of outputs and outcomes, not enough of a focus there. So perhaps, again, taking a leaf out of India, one of the things that could be done is to try and create more competition, more accountability by publicizing the outcomes, that provinces, local governments, how are they delivering in terms of educational attainment, health outcomes, and trying to engender more accountability, more publicity about which local governments are doing a better job of providing goods and services and outcomes, and which ones are the weakest ones. League tables that can be published. Perhaps this is being done. It's been a while since I worked directly on South Africa, so forgive me if I'm overlooking something. So I think there is, as much as kind of the more macro level thinking about new growth sectors, there is also more micro drilling down that needs to be done to facilitate and foster state accountability. Let me stop here, and I can intervene again if there's time. Thank you.
Thank you very much, Abebe. And yeah, a couple of very interesting and important things there. I'm interested in the idea that how we think about debt tolerance is going to change, at least for a while. And that certainly presents us with an opportunity in South Africa, which we're probably taking full, maybe excessive advantage of. But the other thing is, debt is going to come with costs. And the interest associated with that is going to put the government budget under considerably more pressure. And so how does one think about shifting a budget towards investment when so much of the budget is being consumed by wages and interest? The other question I have coming from what you said is the Indian analogy and the need to find new sectors of private sector growth. And obviously there's a strong role for the government in that. But at the same time, there's a massive role for private investment. So we have this need for private sector investment, for SOE sector investment, and government investment in things like urban infrastructure, while the savings base of the economy is not sufficient to sustain any of this, making us highly reliant on additional sources of that, but also including costs and vulnerabilities. One of the audience has introduced a number of interesting ideas, especially relating to the political economy, which I think is an important part of what we're discussing. Laurence, let me hand over to you. I don't know if you've got any thoughts or ideas about how we move beyond diagnostic on the macroeconomic level. Maybe there are other areas we are failing to diagnose, and as a result, not really addressing the issues.
Matthew, thank you very much to you, Matthew, and to ERSA for inviting me to be on the panel, which I think is a very interesting. I think the contributions to the panel and the contributions in the chat question and answer part have been very, very valuable. I think really I was very interested that you started out your presentation, Matthew, just by summarizing issues around the RG inequality model of debt sustainability, because the RG inequality model of debt sustainability, of course, is a long-term perspective on debt sustainability. And what we're facing is an immediate crisis and a very serious fiscal dimension to that crisis. But the panel and all the contributions, I think, have quite rightly focused on the long term. And I'm going to do that myself. But having said that, I'd just like to start by saying that the short term can come up and hit you quite hard. In the short term, nasty things can hit you quite hard. And those come down to the financial crises that can hit. In South Africa, what we're talking about really is probably not so much a crisis within the, starting within the financial sector itself, but a crisis of financing the state and through debt financing. That's for years we've looked at the South African sort of debt structure as being given quite a lot of protection, because not only was the debt to GDP ratio relatively low, but even when it started to rise, the debt to GDP ratio comprised to a large extent quite long maturities of debt, and quite a high proportion of that debt was held locally and denominated in rand. That's changing, and countries run into serious trouble when that starts to change fast, and that can change very fast in South Africa. We can find ourselves having a very rapid shortening of the maturity structure of the debt, and together with that, a rapid increase in the proportion that's foreign held and dollar denominated. So that's the prospect that the politicians and policymakers have to keep at the forefront of their minds all the time. I think the discussion that we've had about the need to anchor medium-term expectations is very pertinent to that. I think it's quite clear from other countries' experience that you can stabilize some bad debt dynamics in the short term, or in the short to medium term, by having a clear medium-term strategy that really is a convincing commitment. The question is, what kind of strategy could one have? We pointed to debt reform, to pension reform as being the kind of quick commitment you can give to convince people that we've got a medium-term anchor there. South Africa, that's not so easy, but reform of public sector wages and public sector wage structures and overall levels is the type of commitment that can be given if it can be implemented. That's the big question with everything is can things be implemented? And for me, the political economy of South Africa is at the heart of what's preventing implementation of the well-meaning, I don't know about well-meaning, but certainly well thought through and well discussed economic strategies that have been on the table for so many years. The fact we haven't been able to implement them is really a political issue. In a paper that Michael Sachs wrote about a year ago, he wrote that it's the politics stupid, and he argued that we need to have a professional state that can act autonomously from party politics and from special interests. I'm still quoting, "We do not appear to be moving in that direction. The main constraint on public infrastructure investment is not access to capital budget allocations. It's the institutional failure of the public agencies that are responsible for infrastructure, building roads, water systems, communications networks, and electricity, etc. All these agencies were able to finance their investments until they were hamstrung by policy paralysis. And that's the issue. How is it that we have a governance structure, the governance structure that's been built since from 1994 onwards, with some admirable democratic qualities built into it, but it's a structure that prevents action and implementation. I'm not a political scientist, and so I'm not going to propose solutions. But it does seem clear that our political structures are currently set up so as effectively to protect insiders, and to protect the protection of insiders is not a good basis for creating a dynamic state, creating a state that can foster a dynamically changing economy. Basically, the structure of the South African economy has not changed much in recent decades, whereas other countries have radically changed the structures of their economy. And that's because our structures are protecting insiders. One can point to particular parts of the economy. One can point to DTI, for example. Whatever its objectives, the outcomes of its industrial policies have been effectively to protect the existing powerhouses within the economy, rather than opening the economy to new forces and new sectors, and to innovation. But that pointing to DTI is beside the point. That's not simply the DTI. It's throughout the structures that we have those cases, those examples. We have them strongly in the labour market. We have them strongly in the institutional structures of the labour market, and we have them elsewhere.
Thank you very much.
I haven't quite finished, but I'm happy to.
Sorry, Laurence.
A particular, just thinking in terms of the constraints that we face, and we've had binding constraints indicated in our discussion. Of course, power, electricity is a major binding constraint. A binding constraint that is very clearly has been very clearly worsened by the insider protection of Eskom and the Eskom coal complex, which has effectively prevented the entry of new power producers and new energy systems, despite the fact that the IPPR was originally successful. Eskom, the structure within which Eskom operates has effectively prevented a rapid development of new successive series of IPPR auctions and growth. But putting aside Eskom and electricity, the other constraint that faces throughout the economy is the skills levels, and that comes down to, and here we come very clearly back to the long-term dynamics, coming back to raising long-term growth rate. The clearest constraint, which is quite shocking, is our educational system, and that's a very clear case where implementation has failed because resources have been there. South Africa spends a much higher proportion of its public sector budget on education than comparable countries, but the outcomes have been far below that of comparable countries, it seems, and we know that when we look at the education system, at basic education level or further, at all points on the scale, we're faced with situations where insiders, basically the education teachers' trade unions, are able to control things together with the local power structures, local municipal power structures, to protect inefficient teachers, ineffective schools, as well as the poor provision of facilities and so on. It's those power structures throughout the economy that have to be shaken up. That requires a stance from the top. In every case where we've seen countries develop fast growth rates with support from inflows of foreign capital, where we've seen that happen, it's come about because the political structures at the top of the government have been able to develop a clear and convincing strategy, which has been able to create a consensus within the country that we're going somewhere, that we're able to do something. South Africa's current structures don't seem to permit that kind of political strategy to develop. There was it could have developed after 1994. It could have developed after the change of presidency to that of President Ramaphosa, but it hasn't developed. There, I simply ask that we turn to our political scientists. Thank you, Matthew.
Thank you very much, Laurence, and thank you very much for kind of introducing or covering the political economy dynamic. I think that it's terribly important, and I'm going to hand straight over to Federico Sturzenegger, especially on this, because Federico, you and I were having a chat the other day, and you were making the point that you guys seem to know what it is you need to do. It's just that nobody's doing it. And the problem doesn't seem to be technical. Perhaps it's political. So it'd be interesting to get your point of view on that. I would say that we're almost out of time, though. So we're going to look to wrap it up as soon as Federico's done. Cheers.
Terrific. Thank you. Thank you for the invitation. A pleasure to be here. And let me be very, very brief because I think we're running our budget constraint and people will start leaving. So no, I would say I was in South Africa in 2006, 2007. That's when I had the honor of meeting Laurence at the time. And the discussion there was on the skills, lack of skills in the South African economy and perhaps the real exchange rate appreciation. So certainly there were the problems of an economy which was growing and was facing a constraint in the labor market. But when you come back in 2019, 2020, the topics that are being discussed are very different because now we're discussing fiscal sustainability, which was not an issue there. We're talking about network industries, which did not appear at that point as such a salient problem, and the lack of growth, and people talk of lack of growth as if, okay, let's turn on a keyboard, and then we start growth. And I think everybody here, starting with Johannes, have mentioned how difficult that is to be done. So I really like the dimension space of Ricardo. No, you have policies which can help for growth. There are policies that can help for inclusion, and there are policies that can help for the fiscal improvement. So we should actually work finding those which help on the three, which, by the way, would somehow bring together the two camps that Abebe was mentioning, If we find something that helps on the fiscal and helps in inclusion and helps in growth, then we kind of are, everybody's on the same boat. And so we should focus on there. And what I think is there are a lot of things that can be done in that dimension that for some reason kind of don't happen, okay? And I want to share with you one experience, one story, which is from my region of the world. It's not from Argentina, it's from Brazil, that illustrates this and has to do with the airline business in Brazil. And what happened in Brazil was that one day the state-owned company, which was named Varig, you all know Brazil, you know, a very large country, was actually trying to reduce the price of airline tickets inside the country. So the president at the time, which was Lula da Silva, which was a very left-wing government, received a commission from the bus drivers. And the bus drivers were opposing the airline, the state-owned airline, reducing the price of the tickets. Because as you know, if they reduce the price of the ticket, why would someone get on a bus to go from Sao Paulo to Recife if they can do the trip in 2 hours in the plane instead of doing it 24 hours on the bus? So they were asking the President Lula to not allow the airline, the state-owned airline, to reduce the price of the tickets. So Lula listened to them, and when they left the room, he basically decided the total deregulation of the airline industry, because he says, I'm not here to have people stuck on a bus for 1 day or 2 days when they can actually do it cheaper on the airline. Well, actually, then he deregulated the industry. Actually, what happened is that 2 years later, Varig went bankrupt because you had a lot of low-cost airlines coming into the market. Over the next 5 or 6 years, the price of airline tickets in Brazil came down by a half. And the number of people that move themselves within the country in airlines multiplied by 6, okay? So this was a reform which was actually good for economic growth, was very good for inclusion. And well, the origin of this specific reform was inclusion, actually. So I've talked in the previous session about ESCOM and how, you know, the deregulation of the electricity industry reduced electricity prices 40% in Argentina, which helped the industry. We could talk about ports. We could talk about telecommunications as a way of generating more inclusion and more growth. We could definitely talk about education, which is what Laurence just mentioned. I mean, could you think of a policy which is more inclusive and it's more growth generating, which is just basically endow every South African with human capital? My country, Argentina, did this at the end of the 19th century, which is to make a very efficient public education system, which basically gave equal opportunities in terms of access. But still, that hasn't happened. And Laurence just said it. I mean, it's not a lack of resources, it's a lack of implementation. So just to finish, I think South Africans need to do a little bit of soul searching and saying, look, why these things that are good for inclusion and are good for growth are not happening. We're not able to do it. It's an insider story. It's a lack of leadership. It's a lack of state capacity. And how do we actually get to solve this problem? But I think it's a question that you yourselves will have to find the solution to that. But I think it really will help to bring those two camps together to focus on these things where everybody has to be in agreement that they're good from a perspective of inclusion, and they're good from a perspective of growth, and eventually for the fiscal as well. So I think I think that's the question that I think South Africans need to make themselves and think very deeply about. And let me stop there because we don't have time.
Thank you very much, Federico. I have set us a hard deadline of finishing at 5 exactly, so I've got a couple of seconds to wrap it up, but made easy by the fact that I couldn't have asked for a better kind of closing contribution. And certainly the example of the airline industry is a very pertinent one in South Africa too. Firstly, nothing is new. It's either been done somewhere else or we've decided we need to do it years ago and we just haven't done it. But throughout this series, I've been thinking to myself that, you know, there's value, there's contribution, there's importance in all of the contributions that have been made. The problem is our inability to find that intersection. No, I think we can find the intersection between those issues that you raised. The problem is our inability to commit to undertaking the reforms that will deliver on that intersection. In a way, it's our failure to manage the short-term losers in what is ultimately a zero-sum game in the short term by motivating and accepting the long-term winners. And that is a political problem. The choices that we face, that we need to make, do genuinely create losers in the short term. but they are for the intentional purpose of generating a lot more winners, as your example, I think, very aptly describes. On that, let me thank all of the panelists for the very important and valuable contributions. Abebe, I understand that you got a hard deadline to get to, but I think that the other panelists also have important work to do. So thank you very much, and thank you very much for the attention of the audience. Margot, over to you for any wrap-up contributions or statements you want to make.
Thank you so much. Yes, just a big thank you to all the panelists, and thank you, Matthew, for organizing. And like Ricardo said, a platform where we can discuss these ideas openly and draw attention to make ourselves aware of what we need to be serious about. I think it's been a really valuable contribution. So thank you, everyone. And as always, please stay tuned to our website and our social media channels. We will definitely let you know next time something like this happens. Thank you very much. Have a good evening.
Bye-bye.